You may or may not have realised that the new tax year has landed, and I thought it would be helpful to give you a rundown of all the tax allowances you can take advantage of in the coming months. Now, I am not a tax expert, and your tax situation may mean that some of these allowances aren't available to you. So what is a tax allowance? Basically, they are systems created by the government so that you can pay less tax. I remember doing a post about this topic on TikTok a year or so ago, and someone accused me of tax evasion. This is not what this is. The government wants you to use allowances as its way of managing the economy. They change these allowances every now and again to incentivize either spending, saving, or investing. Therefore, you shouldn't be worried about using them. They are there for a reason. The numbers could well change next year, and they could even change mid-year. So make sure to research the correct figures before you take any action. Where to start then? I recommend that you start by taking a look at your tax situation from the last year. If you've never done this before, then don't worry, I can give you some pointers. A great starting point is to check your P60. This is a summary of the tax you have paid on employed income in the previous tax year. You should get a P60 for each job you do. If you quit a job partway through the previous year, you should have received a P45, which will tell you how much money you made from that job during the tax year and the tax you paid on it. It is good to check things like your tax code too. You can always speak to your employer if you think there is an error here. For those of you that are self-employed, this is a great time to get last year's accounts in order and think about sending off any self-assessments early. It will save you the hassle of rushing around come January next year. With your income-related tax now checked in on, you can now look at savings and investments. You might want to see how much you paid into your pension and your ISAs last year. Check if you've received any dividends outside your ISAs, or if you earned any additional income that you might need to complete a self-assessment for. Don't worry, I'm going to cover these terms in more detail shortly, so hold tight. If everything from last year looks as it should, then you can turn your attention to this new tax year and how you can take advantage of the tax allowances that are out there. So the first one is ISA allowances. I'm going to start with ISAs, or individual savings accounts, because I love them and there are a few of them to cover. Essentially, ISAs provide a tax-free wrapper around certain savings and investment accounts. This means that any money made within an ISA is free of tax. This could be interest payments on savings or growth or dividends from investments. Naturally, there is a limit on how much you can pay into these accounts annually. For adults, this is £20,000. I will talk about junior ISAs in just a bit. There are 4 types of ISAs: cash ISAs, stocks and shares ISAs, lifetime ISAs, and innovative finance ISAs. You can spread your allowance out over each of these types of accounts, or put your money in just 1 or 2. This is most advantageous for people who want to invest, as there are other allowances on savings accounts that mean the cash ISA isn't maybe a high priority. For most of these, there are no specific requirements surrounding age or the amount that you can pay in, within the allowance limit, of course. But there is one exception. The lifetime ISA has 2 purposes. It can be used to save for your first home or for retirement. Any money paid into a lifetime ISA is considered part of your total ISA allowance. The maximum you can pay in to a lifetime ISA in a year is £4,000. The real perk of a lifetime ISA though is the government bonus. You get a 25% bonus on any money that you pay in. So this could be worth up to £1,000 per year if you pay in the full amount. There are lots of rules and age restrictions on these though. I have another video all about ISAs for you to check out at the top of this video. Your kids get an ISA allowance too. It is less than the adult allowance at £9,000 per tax year, but still offers the opportunity for tax-free savings or investment accounts. Any money that is paid into a junior ISA can't be touched until that child turns 18, and the money is legally theirs. Therefore, you need to think carefully about ensuring that you can afford to move this money into these accounts. Personal savings allowance. Before I move on from ISAs, I want to follow up on the earlier comment I made about ISAs being more worthwhile for investors than savers. Now this is because of the personal savings allowance. Every basic rate taxpayer can earn £1,000 in savings income per tax year without having to pay tax on it. What this means is that regardless of where you are keeping your money, you can earn £1,000 in interest before you have to start paying tax. Currently, interest rates are quite low. The highest I saw when looking today was 2.28, and that was if you locked your money away for 3 years. At those interest rates, you would still need nearly £44,000 sat in that savings account before you had to worry about paying tax on the interest. Let's talk about income now. Most employed people have to pay 2 types of tax on their income: income tax and national insurance. Both of these come with a personal tax-free allowance, meaning an amount that you make that you don't have to pay tax on. Once you go over that threshold, you will pay tax on anything above it. For income tax, you can earn £12,570 before paying any tax. And for national insurance, this stands at £9,880 presently. Note, however, that the national insurance threshold is increasing to match the income tax threshold from the 6th of July 2022. In the past, my husband and I were able to take advantage of these allowances. After having kids, we determined that we would have more income if we both worked part-time and looked after the kids the rest of the time. This was largely due to the fact that we were both able to use our tax-free personal allowances and consequently paid less tax as a couple. Let's talk about pensions. So this is another area you have probably paid little attention to in the past, but pensions have an allowance too. This allowance sits at £40,000 per year for most people. What this means is that you can contribute £40,000 this year into your pension without having to pay tax. At this point, I'm aware that these numbers sound really high. You've got like £20,000 for ISAs, £40,000 for pensions. Most people won't even get close to maxing these out, but it is good to know the figures just in case your luck changes. Dividend tax. Dividends are paid by companies to shareholders. You might earn dividends if you are an investor or if you own your own business. Like everything else, it has a tax-free allowance, and that figure sits at £2,000 for this tax year. If you are investing through a stocks and shares ISA, then you won't pay any tax on dividends earned this way anyway. This allowance can be used for money invested outside of that ISA. Many self-employed people pay themselves dividends through their company, so this allowance may be more relevant to them. Capital gains tax. So this one is a little more complicated, but still important to talk about. The first point to make is the tax-free allowance for capital gains tax for individuals is currently £12,300. What is trickier is what you have to pay capital gains tax on. The simplest explanation is that it is a tax on the gain made when you sell something. This could be stocks, personal possessions, or a property that's not your main home. Naturally, there are lots of rules about what is and isn't included. You will have to pay tax if you sell your stocks and make a profit on them, unless you invested through an ISA or you are below the capital gains tax threshold. Inheritance tax and the gifting allowance. If you peg out and leave an estate worth more than £325,000, then tax will be payable on any amount above that at a rate of 40%. Now, because of this, you might think that people would try and give massive amounts of their wealth on their deathbed, but these can also be liable for inheritance tax. This applies to any gifted amounts in the 7 years before you die, but there is a gifting allowance. This is £3,000 per year. Now, this can go to one person or be split across multiple people. You can also roll over your allowance too. There are also other amounts that you can gift for, say, weddings. So if you want to reduce your loved one's future inheritance tax bill, it might be something that you want to look into. The last one to mention is the marriage tax allowance, which is available to married people where one person is earning below the personal allowance for income. This can work well if, say, one person works part-time or is reducing their income due to maternity leave, for example. The lower earner can then gift up to £1,260 of their personal allowance to the other partner, which would reduce their tax bill by up to £252 this tax year. I have a full video about this, so make sure you check it out for all the details. Like I said, I don't expect you to be able to use all of them, but it is good to know they are there.